Welcome back to Financial Freedom with Jewel. Today we're going to talk about paying that mortgage off, not in 30 years, not in 20 years, but in a third of the time. But I need you to give me one moment, I'll be right back.
I'm a stranger, willing.
So you're excited. You have the new home. You're excited about having the American dream, so you thought. But there's a better way to pay off that American dream, not with a 30-year mortgage. Could you guys believe this? They are not offering 50-year mortgages. No, that's not the way to go. Quick caveat. The reason why the banker is going to give you a 30, 40, or 50-year mortgage is simply because he knows something that you don't know. He knows that as he entices you with that little bitty small payment over 30 years, he is actually getting rich off of the interest. That is how bankers make their money. So they'll say, hey, here's 30 years, here's the payment, give me my interest. But what he doesn't tell you is that when you're paying on that mortgage for at least the first 5 to 6 years, you're paying nothing but a high amount of interest. Very little bit of that is going towards the principal. But with Velocity Banking, I'm going to show you a method that you can use using a HELOC. A HELOC is a home equity line of credit. The home equity line of credit is really tied to your home. Now, for some of you who are risk averse, I'm going to say if you have $20,000 in savings or maybe a 401k, you can even use that, you guys. Let's take a look at this chart. Okay, look at the income here. We're going to just speak general numbers. $6,500 a month income, $4,500 a month in expenses. We're talking mortgage, we're talking insurance, we're talking, don't forget, fund money. Fund money, like I tell you, take out fund money. Things like going to the movies, going out to eat, going to get your hair done, your nails done, guys' night, tickets, concerts. You want to make sure you designate so much of that every single month in your budget. But I'm going to tell you to go a little step further. Don't just say, oh, I have $200 I'm going to spend a month on my fund money. Nope, put that in an envelope. The reason why I say put in an envelope is because if you have it in your maybe a debit card, you're going to keep swiping. If you set aside, let's say $250 every single month for fund money, when that envelope is gone, the money's out of there, you cannot dip into your debit card. So it just kind of keeps you, it keeps you disciplined because you're only using what's in the envelope. Remember, with Velocity Banking, we don't say live as if you're on maybe beans and rice. You can if you want to, but we say don't do that because it's like a diet. If you feel like it's restrictive or too much, you're going to give up after a little while. With Velocity Banking, we want you to succeed. Okay, so I digress. Let's get back on track. So all of that expenses, $4,500. And look at this. You have $2,000 left over at the end of every single month. Remember, cash flow is income minus your expenses. Cash flow is what you have left over. So remember, I told you they have a $250,000 mortgage, and the mortgage is at 3.5%. That is excellent. Most folks are not going to move off of that because they're comfortable with that. Let's go ahead and make it work for us, and let's pay it down. Okay, now here we go. We're going to take and we're going to use our HELOC. We have a HELOC of $30,000 at 7.5%. Although it's at 7.5%, because it's an interest-only loan, it's going to be very, very cheap. Remember, with any loan you take out, you have to pay an initial amount to your banker for borrowing the money. 7.5%, we're going to give him his portion, but I am going to tell you with this $30,000, let's chunk off $20,000. You may choose to go ahead and go and chunk off maybe $30,000, but I just say, let's be safe with it. Let's just go ahead and chunk off $20,000 and directly inject it into that mortgage payment, which means we're not going to say, oh, we're going to put this at the mortgage payment. We're going to call the mortgage company. We're going to say, look, I'm going to pay $20,000. I want to go in towards my principal. If you don't do that, they're going to put it on the bottom end of that loan. You don't want that because you'll be able to see your interest payments actually going down, and you will see the principal going up because you're applying towards your principal. So we're going to inject that $20,000 directly into that mortgage, bringing it down to $230,000. Now, this is also something we need to consider because we know we have $2,000 cash flow at the end of every single month. Remember that. That will let you pay this off in 10 months, okay? Can you see what's going on here? First 10 months, okay, we got that down. Let's inject another $20,000. Look at this, you guys. We're going to be down to $210,000. Not to mention, you are also paying your mortgage off every single month, $11.23. That's going to stay there. That's all a part of your expenses. It's already calculated. We're working off of the positive cash flow. Now we're down, in 10 months, we're down to $210,000 that we owe on our mortgage. We've injected another $20,000. It's going to take us, you guessed it, 10 more months to pay down the difference. Okay, we paid it down. Let's go for another 10 months, another $20,000. You guys, we're down to $190,000 on that mortgage in about 2.5 years. That doesn't happen doing it the regular way of the regular way of banking and paying your low payments. You people might say, well, that doesn't make any sense. You're just injecting the cash flow into your principal. What you're doing is that you're actually running all this down. Therefore, you're not paying as much, interest. The bank is not winning. You are not winning. You're on the other side of the winning game. Let's go ahead, you guys. Another 10 months, chunking off $20,000. Look at this. Now we're down to $170,000. That's in 10, 20, 30, 40 months. That is 3.5 years. Remember, you started off at $250,000. There's no way doing a traditional banking that you can run down $100,000 in 40 months. It just doesn't happen. Not on the amortized schedule. But on this way, velocity banking, you can see we're constantly chunking and hitting that. I'm going to say something. Remember, because the HELOC is in place, that's your emergency money, and you can use that because you're borrowing, you're paying it back. But also, let's say you had a month where maybe your car broke down. Maybe you want to go on vacation. You want to use a HELOC. That's fine. If you have to jump off course, it's okay. The HELOC is there as a cushion to kind of hold you, or also to pay down debts. And some folks choose to go on vacation. If you want to have a good time and you maybe say, look, I'm going to go on vacation this month, I might need $5,000. Okay, we'll just chunk off $15,000 directly towards the principal on the mortgage. Use the other $5,000 for your trip. Okay, that way, as you can see, you're still living your life, you're still enjoying your life, and you're still paying your bills. Let's say maybe you had to do a repair in your home. You guys, that HELOC is there for that very purpose. I'm just saying, when it comes down to it, you can be strategic and run down your mortgage payment. That way, guess what? If you decided that you were not going to sit in that house for maybe 20 years, 10 years, guess what? Because you're doing velocity banking, when you go to sell the home, you're going to have so much more equity in the home. You're going to make more of a profit. So it works whether you're going to sell the house, whether you're going to live in the house. It doesn't matter. You are benefiting now because you're going to pocket more. Whether you sell or whether you hold and you invest, you hold on to it and you rent it out. Remember, it's paid in full, so there is no money you owe to the bank besides your yearly taxes, okay? So now we're down to $170,000. Let's chunk another $20,000, right? We've chunked 1, 2, 3, 4, 5. Now we're down to $150,000. That's in 4 years and 2 months. You have gone all the way down. If you continue on this cycle, you guys, this house will pay off in a third of the time. 10 years, maybe less. 12 years, maybe less than that, I'm sure. But it won't go past 12 years. Remember, the bank, his job was to go and have you in that mortgage, 3.5% interest rate for 30 years. You jumped out of that cycle. You're still paying him his, but you're also using your cash flow to speed up paying that mortgage. Now, had you stayed in here, you'd have given that banker about $150,000 in interest alone just to borrow that $250,000. Velocity banking way, you're only going to give him about $40,000 to $45,000 in interest. You're going to save about $110,000 in interest alone doing the velocity banking way. Remember, it is very easy to understand. Velocity banking is simply using your positive cash flow. So you have to have positive cash flow. You cannot spend more than what you bring in. If you are really responsible, look at this, you guys, and we're saying targeted. Maybe you have $2,000. Maybe you said, look, my mortgage is paid off. Well, that's awesome. Maybe you can use that as an investment. Maybe you can go ahead and put that into maybe stocks, options, things like that. And guess what? Compounding interest when you do, different type of investment accounts. You have interest compounded every single month off that $2,000. One thing I've done is that I've actually put all my extra money into a high yield savings account, only because I know that when I do a high yield savings account, it's not like a traditional savings account where I'm getting 0.01% after a whole year. We're talking pennies on the dollar, which means the bank's going to take your money and he's going to make money and give you pennies for doing it. If you do a high yield savings account, you're going to get much more. They're going for 4% now, you guys. I go to Everbank because Everbank just works for our family. So if you have extra left over, don't let it just sit in a bank account. Invest that money. Put it in stocks. Put it in bonds. Put it in a high yield savings account. You want to make your money work for you. In this case, they're put into their mortgage. They're running their mortgage down in record time. 10 years. Not bad compared to 30 years. Take a look. Until the next time, to the next video, I'm Jewel, your financial freedom friend. I'm here until you win. But also, if you found value in this video, please like, subscribe, and share. Sharing is caring. Everybody should be able to get out of debt. This is the way to do it. Okay? To the next video. We'll see you. Bye-bye.